Thank you everyone for joining us. My name is Tanya Rule, and I lead the Affordable Care Act services for the firm. So I sit in our Mankato, Minnesota office. Obviously, I sit currently in my home office. That being said, you can still call me at my office line or email me, and those ring right to my home office desk. So if we don't get through all of your questions, please send me an email and I will respond to it as I'm able, hopefully within the end of the day. So here are our learning objectives. We'll go through each of these. Now at the end of the presentation, I do have some examples of some forms and how to fill them out. If we don't get through all of them have the answers on them and they're pretty self-explanatory, so read through them. They should hit most of the items that you will see on your forms. So the forms were extended. So if you remember in the past years, we've always gotten this extension somewhere between Thanksgiving and Christmas. This year, the IRS actually gave it to us a little bit early. So it was on October 2nd that we received that extension. And that extension came through on IRS Notice 2020-76. Now, just like the prior extensions, it only extends the due date or the deadline that you can give the forms to the individuals, so your employees. And so you get an extra 30 days to give those forms to your employees. So that 30 days actually brings it to March 2nd. Now, just like in prior years, it doesn't extend the due date to give those forms to the IRS. So unless you file for a separate extension, that due date is, it's the end of February if you mail them, but since that falls on a Sunday, you actually get until Monday, March 1st. So if you're mailing those to the IRS, you have until that date to get them to the IRS. E-file date is still March 31st. We always say if you're going to mail those to the IRS, mail them about a week beforehand. We have had several clients that mail those forms to the IRS and they mail them right on the due date, and the IRS says that they don't get them in time. There is that same relief for those small insurance company or small employers. So if you're not an applicable large employer, you can put a notice on your website and then the employees can request those forms to you, and then you don't have to give those forms to the employees. I would suggest just go ahead and give those forms to the employees. You still have to give them to the IRS. So this is really meant for like those big insurance companies like the Blue Cross Blue Shields of the world. Let them do that. In my opinion, if you're a small employer, just go ahead and file those forms with your employees. We did get that extension, that good faith effort extension again, but new this year, this is the last year that we will get that good faith relief. So if you make an error on your forms next year, you will receive a penalty for those forms. So I would suggest having someone review your forms. We can review your forms, or have someone in your office just take a second glance at them. When we review forms, about 2% of the forms that we review are actually done correct as is. So again, it's important to have those forms reviewed. Now, this slide we had in here last year, so nothing has changed, but I think it's important to reiterate it. So the individual mandate, that has been repealed. Now, there's a lot of misconception that because that mandate was repealed, the employer mandate was repealed, and that is not true. So the employer mandate is still obviously in effect. You still have to file those 1094 and 1095B forms or the C forms if you're a large employer. Now, it could potentially mean that you have lower penalties, right? Because if we have employees that aren't, that don't have to have insurance because there's no individual mandate, odds are there may be fewer of them that go to the exchange and qualify for a premium tax credit because maybe they don't want to get insurance. There's no need for them to have insurance, so to speak. So that would mean you'd have less penalties coming back, because remember, if you're a large employer, if you don't offer insurance to any of your employees, as long as none of those employees go to the exchange and receive a premium tax credit, you would never be hit with a penalty. So again, because there's no individual mandate, the thought is maybe the penalties will be reduced for some employers. Now, there are some states that do have their own mandate. I suspect that this is going to grow in the future, but we'll just kind of hit on some of the states that are currently expecting you to file forms with them right now. There are, like I said, because these states have an individual mandate of their own, if you're a large employer or if you have a self-funded plan, depending on the state's rules, you could have a filing requirement with that state. So New Jersey, they have a filing requirement if you if you have a self-funded plan. Now, California, like New Jersey, says that the employer is always responsible for making sure that the insurance company files with that state if you have an employee in that state. So even if you have a self-funded plan, it's important to go back to that company or that your whoever insurance you have, if it's with Blue Cross Blue Shield, Health Partners, etc. Make sure they're filing with that state if you have an employee in that state. Now, New Jersey says even if you have a part-time employee living there, meaning they're a resident for part of the year, and it's actually only 15 days, you have a filing requirement with them. DC has a filing requirement as well. So those states were in 2019, so nothing new for this year. So for 2020, the states that came to the table were California, Rhode Island, and Vermont. Again, California, that's just if you're a plan sponsor. So if you have a self-insured plan, you would have a reporting requirement with them. If you have this, remember that those states' filing requirements are different than the federal. So not only could the forms change, but the due dates could change as well. So like California, you have to currently get those employees their forms by January 31st. If you have a fully insured plan and you have an employee that lives in California, the insurance company should be filing that form, but you should check with that insurance company and make sure they are doing the filing that they're required to do. So there's 3 types of health reimbursement accounts, and I just want to touch base on these because one of them is new starting January 1st of 2020, and those are our ICRAs, our individual coverage reimbursement arrangement. Health reimbursement arrangement accounts. Like I said, those came out on 1/1/20, and any size employer can use these. And what's nice about the ICRAs is they are considered, if you offer an ICRA, it's considered offering your employees minimum essential coverage. So it gets you out of the larger of the 2 pay or play penalties that we'll talk about in a minute. So if you are a large employer and you haven't been able to keep up with the premium increases in your group plan, maybe some of your employees aren't taking the group plan because it doesn't really fit their needs, and you want to move the employees to an individual plan, the ICRA might be something you want to look into. Again, you need to do it by, if you're going to start it January 1st, you need to do a couple steps prior to that. So you need to send the employees a notice 90 days in advance. So if you haven't done it yet, you'd have to back up that plan start date. You obviously can't you can't start it on January 1st, as that employee needs that notice 90 days prior to that. But I've seen the ICRAs really be a benefit for some employers. Again, there's a time and a place for it. If your group plan right now is satisfying your employees, obviously you'll probably want to stay with that. But otherwise, there are some opportunities out there if you want to move to individual plans. You do have to have a plan document for any of these 3 types of HRAs. Next, we're going to talk about the Qualified Small Employer Health Reimbursement Arrangement. Now, this has been out there since President Obama signed it back in December of 16. So it's been out there since January 1st, you could have had it, but this is only for small employers. So it again reimburses for individual coverage. In my opinion, the ICRA is easier to use than the QSERA, so to speak. There are differences. I'm not going to go into a lot of detail because honestly, we could spend a whole hour talking about the differences, but know that if you're a large employer, you can't use the QSERA. Now, a one-person HRA, anyone can do a one-person HRA. If you're going to have a one-person HRA, it has to be for premiums only. Otherwise, if it's going to reimburse for medical expenses, you have to worry about the non-discrimination rules as well. So another new item that came up this year was in February of 2020, there was a Chief Counsel Memorandum that was released. And this Chief Counsel Memorandum was quite damaging in my opinion. What it said is there is no statute of limitations on these ACA forms. Basically, if you read the memorandum, it came out and it said, because the penalties under 4980H, those are your pay or play penalties, they can't be readily determined just by filing your 1094 and 1095 forms. Because remember, we have to wait until the IRS matches what the exchange is saying as far as what employees went to the exchange and received a premium tax credit. So just by an employer filing a 1094 or 1095-C, it doesn't really tell the IRS what that penalty is going to be. Because of that, there is no statute of limitations. Now, that goes against what it says in the IRS instructions. So if you read through the instructions, the 2020 instructions, it says keep your forms for 3 years. However, this chief counsel memorandum will overrule that. So what that means is you need to keep your forms indefinitely, and you also need to keep the backup documentation for those forms, such as your signed waivers, how you determined if an individual was full-time or part-time. If they weren't offered, write down a reason, keep everything in your file. We actually had one client come in, I think it was the end of September, or maybe it was even October, and they had received a 2015 notice. So those notices can come at any time. So just a caution, keep all of your information forever. Then in June of 2020, the Treasury Inspector General for Tax Administration gave the IRS sort of a poor report, if you will, on how the IRS is doing in reviewing these ACA forms. What they found is that the IRS was allowing that good faith relief, even if the employer was making the same mistake year after year after year. And they didn't agree with that. They thought that those penalties should be sent out to the employers. So that being said, I wouldn't be surprised if we see the IRS coming down a little bit harder on what they're looking at when they look at those forms. So if you get a notice from the IRS, it'll probably be one of these letter 226J notices. I wouldn't be surprised if you have to submit a little bit more documentation to the IRS just so that the IRS can kind of cross their or dot their I's and cross their T's, so to speak. Now, those letter 226J notices, those go out to employers saying, hey, we think you owe a premium, we think you owe an employer shared responsibility payment because someone received a premium tax credit that worked for you that was a full-time employee. So usually if you get one of these notices, you can tell within a minute or two what is wrong and what type of penalty they're giving you, whether it was the unaffordability penalty or whether you didn't offer insurance to enough employees. You have 30 days to respond. That being said, so far the IRS is pretty lenient on giving you an additional 30 days if you can't get all of your paperwork together. Now, hopefully most of you are keeping a file with all of this information in it, especially when we know now that there's no statute of limitations. I had this in the slides last year if you were listening. That Accounting Today article on August 7th of 2017 said, you know what, they think the IRS is coming down a little bit harder on these penalties too. Get your forms reviewed. Have a second eye look at them so that an easy error isn't being made. Another notice that's out there that we still see a lot of is that letter 5699. Now, if you got one of these letters from the IRS, basically it's the IRS saying, hey, we think you might be a large employer, but we aren't seeing any of your 1094 or 1095-C forms. Are you not a large employer, or where are your forms? Now, if you have responded to this and sent the IRS your forms, it could be a COVID issue. The IRS is really running behind because of that. That being said, they still want you to respond within 30 days. Again, they're pretty lenient about giving you a 30-day extension. Oftentimes, you can get a second 30-day extension too if you need to file those forms. I would suggest, again, if you're responding to this to the IRS, make sure everything you send to the IRS has some sort of a mailed receipt, like a certified mail or something, so that you can track when the IRS is getting it and you can keep that tracking in your file. Anytime you send anything for the ACA to the IRS, it's recommended to do that. Now, if you do receive a letter 226J or a letter 5699, assuming there's no forms that you have to file with that 5699, if you're responding to that, my suggestion would be to fax that response to the IRS. They seem to get their faxes a little more timely, if you will, and they get through them quicker if you do that versus mailing it. There is another notice, a 972CG notice. We see this coming out to employers who maybe they mailed their forms to the IRS and they mailed them on time, but the IRS is saying that they didn't mail them on time. So that's for a late filing, or we've had some clients get this notice because they're mailing their forms when they're required to e-file their forms. So if you have 250 or more forms that you're filing, remember you have to e-file those forms or you will get this notice. So next we're going to talk about the applicable large employers. So again, nothing has changed here. Your magic number is 50. We'll talk a little bit about those employees that were furloughed or laid off and what they do to this number. But remember, this number is always based on your prior calendar year hours. So if you're a large employer for 2020, you already know that because it was based on your 2019 hours. Now we're not going to go into the calculation of how to do that because nothing has changed here since the ACA came out in 2010. But just remember that it's always based on 120 hours. It's not based on 130 hours like a full-time employee is once you become a large employer. So again, it's based on 120 hours a month. But once you are a large employer, then that employee that's a full-time employee is someone who works 130 hours a month. So this is where we're going to talk about those furloughs and layoffs. So a lot of people are under the misconception, if you will, that if you furlough, let's say I have 60 employees and I furlough half of my staff due to COVID or whatever have you. Obviously, there's a lot of furloughs because of COVID this year, so this is what's bringing it up. If you furlough employees or you lay off employees, that really doesn't change your ALE status for 2020 because it's solidified based on your 2019 hours. Now, it likely could change your ALE status if you were right on that 50 number, close to that 50, then it could change your ALE status for 2021. You don't want to get caught in the predicament of not filing your forms, getting a letter 5699, and then remember that good faith effort, it doesn't cover not filing your form. So that good faith effort just says, hey, I made a good faith effort filing the forms, but I miscoded them. I didn't understand what I was doing, whatever have you, but it does not cover late filing of forms. So now we're going to talk about the two pay or play penalties, and those are our 4980H penalties. So the first penalty is the A penalty. Remember, that is the penalty that if you don't offer at least 95% of your full-time employees insurance, it's as if you offered insurance to no one. Again, this penalty would never hit any of our large employers if none of their full-time employees went to the exchange and received a premium tax credit. So theoretically, I could have a million full-time employees, and as long as none of them went to the exchange and received a premium tax credit, I would never be hit with an ACA penalty. So remember, we always get the first 30 free. We'll go through a calculation of that in a minute. And then if I offer insurance to my 95% of my full-time employees, but let's say it's unaffordable to 3 people, and those 3 individuals go to the exchange, say, hey, listen, I waived my coverage with my employer, and they receive a premium tax credit. Now remember, they have to receive a premium tax credit based on their household income. So there's a couple different steps they need to take in order to even receive the premium tax credit. Then you would be hit with this $3,860 penalty, and that's per employee. It doesn't taint the whole group of employees like that first penalty does. Now I have seen it where the employee takes coverage from the employer, and the employer actually gets a certification from the exchange saying, hey, John Doe received a premium tax credit. Please let us know if you feel that that's incorrect. So if the employee takes your coverage, they're obviously not eligible to go to the exchange and receive a premium tax credit. That being said, if they waive coverage and you offer affordable coverage, they can't go to the exchange and receive a premium tax credit. They shouldn't. So make sure if you get one of those certifications from an exchange, whether it's a state-based or federal-based exchange, respond to that right away, especially if that employee was offered affordable and adequate insurance. So here is the calculation of the 4980HA penalty. Like I said earlier, you get the first 30 employees for free. So if you've ever gotten a letter 226J, you'll see, I think it's on about page 4, there's a little ESRP table, and that will break down this penalty. So let's say that I didn't offer insurance to 95% of my full-time employees. And I had one person go to the exchange, but they didn't go to the exchange and receive a premium tax credit until December. I would only have 1/12 of this penalty because it breaks it down into a monthly penalty. So we already went over how this 4980HB penalty works, so I'm going to let you read that slide on your own. So now we're going to talk about the safe harbors. So it's important for you to know that if you offer affordable coverage, you need to put that safe harbor on that 1095C form, because if you leave that out, I know I've seen some payroll softwares, and I don't think it's the payroll software's fault. I think, it's the output's only as good as the input, and the payroll software will not put in safe harbors for people that waived coverage, but they will put in a code for people who accepted coverage. So make sure you're going through those forms and make sure that that's not you, because if a safe harbor is applicable, you need to put that on the form so you don't receive a penalty if one of the individuals goes to the exchange and receives a premium tax credit. Now, these safe harbors, nothing is new with them. They're the same as we've had over the past several years. The dollar amounts do change because remember, it's based on the affordability percentage, and that right now this year for 2020 plans is 9.78%. So again, you have the wages box 1 of your W-2. You would take that times 9.78%, divide it by 12, and the employee can't pay more than that dollar amount for self-only coverage. Now, it doesn't matter what the employee takes. They could take family coverage, but the 1095 is always based on self-only coverage. I've seen people make that mistake. Make sure you're not one of those people. Now, rate of pay, that's the rate of pay at the beginning of the plan year. So if you have 2 plan years, let's say you have a fiscal plan of July 1st, you're going to take the rate of pay that they made in the 2019 plan year for the first 6 months of the year, and then you're going to take the rate of pay from July 1st until December 31st. Remember, you don't include raises, but you do include decreases in pay. So if you decreased someone's pay, you're going to have to take that into consideration in determining that affordability. So here's where we talk about that federal poverty line. So the federal poverty line, that is kind of, if you will, the best of the best insurance offering. So if you offer the insurance that meets the federal poverty line, it's called a qualified offer. And you can use a 1A when you're coding your 1095C forms. Now, what's nice about the 1095A is you don't need to put anything on that line 15 and line 16 of the 1095C. It's not wrong if you want to go ahead and put a safe harbor in, but I always say less is more to the IRS. If you're not required to give it to the IRS, don't give it to the IRS, especially next year when we don't have that good faith effort relief. If you make an error, let's say I use a 1A offer and I say, hey, Tanya took coverage and I coded me as waiving coverage, that form would be technically incorrect when you didn't even need to put anything on line 16. So here are your safe harbor percentages. You need to know this because if you get a letter 226J and you're recalculating that safe harbor, making sure that you did your safe harbor calculations correctly, you're going to want to make sure that you are looking at the right safe harbor. Otherwise, the IRS is going to catch that when you make that response back to them. So you've heard me say something about that 95% rule. Well, hopefully all of you remember from last year that if you don't offer at least 95% of your full-time employees coverage, it's as if you offered coverage to no one. Now, let's assume that you have under 100 full-time employees, then you can use 5, because if 5 employees is greater than 5%, they do give you an error of 5 employees. Make sure that you don't do this, because worst case scenario, let's say I have 100 employees and I make that offer of coverage, and by the way, all 100 are full-time, and I make that offer of coverage to 94 employees. And let's even say it's a 1A offer. Let's say I'm offering insurance and I'm paying 100% of that insurance to all my employees. Now, if I offer it to 94 of the 100 employees, I'm going to get hit with the larger of the 2 ACA penalties because I didn't offer at least 95% of my employees coverage. So now I've paid for health insurance for 94 people, and I'm still going to get hit with the larger of the 2 ACA penalties. So make sure when you're calculating that, you're going to have to do that calculation every month, that you really look at who should have had the offer and make sure that that offer was made. It's always better to offer unaffordable insurance than to not offer insurance because of that 95% test. Now, when we're looking at a full-time employee, we really have to know when we're hiring that employee, are we hiring them as a full-time employee or are we hiring them as a variable hour employee? And there's no bright line test, so to speak. If you are replacing a full-time employee or if the job description and advertisement was for a full-time employee, likely they are coming on as a full-time employee and need that offer within 90 days. So I should say by the 91st day, they need that offer. If you're not sure, you can classify them as a variable hour employee, and if you're using the look back measurement method, you can stick them in what's called an initial measurement period, and you don't have to give them an offer that first year. So here are some terms we're going to go through. Again, review of last year, you can either use the monthly measurement method or the look back measurement method to determine if someone is full-time. And again, if you hire someone as full-time, until you complete one full measurement period, you look at them on a monthly basis, just like the monthly measurement period. Now, I have employers that use the monthly measurement method, and they use biweekly payroll data. Now, technically, you're not supposed to use biweekly payroll data. You can use semi-monthly payroll data, weekly or monthly payroll data. You can use the weekly rule for the monthly measurement method. I'll let you read through this example on your own, just because I'm going to try to get to those examples at the end of the presentation today. So the standard measurement period, that applies to all your ongoing employees. And that is just if I am going to measure all my employees, and let's say I have a calendar year plan, I'm going to measure them for the prior calendar year to determine who is full-time for the current calendar year. Now, if I hire someone as variable or seasonal, they're going to fall into their initial measurement period. Now, in a perfect world, you'd hire everybody on the first day of your standard measurement period and you would never need an IMP, but obviously everyone knows that doesn't happen. So all your employees will get their own initial measurement period, and then that IMP will overlap with that SMP. And then the stability period. So you can have a stability period anywhere from 6 to 12 months. Most of our employers have a 12-month stability period. I would recommend having a 12-month stability period along with a 12-month look back measurement period. You'll see the SMP and the look back measurement period, they're this one and the same. Why I say a 12-month is because we've done studies on different types of industries, and it's better to use a 12-month. It gives you more time to kind of stretch those variable hour employees out so that hopefully more of them fall under the full-time threshold of $1,560 per year. And then you don't have to give them an offer of insurance. Now, you can give them an offer of insurance, but if they're not full-time under the ACA full-time definition, they're not classified as a full-time employee on those forms, so they can't open you up for a potential penalty. The admin period, that's just the period between your look back and stability period. And that gives you time to get those employees' insurance offerings on the table, ready for them to sign the waiver or take insurance. Now I'm going to skip those slides and go right to this chart, and I'm going to walk you through what it means. So we hire this individual, Carter, on August 1st of 2018, and he's not a full-time employee in this example. So his IMP is the first 12 months of him being hired, and then you have a 30-day admin period. Now, if you're using a 12-month IMP, your admin period can only be 30 days. So your IMP and your admin period together can only be 13 months and some change, if you will. So you're going to look at his hours during that IMP, and then if he hits full-time hours, you need to give him an offer during the initial, the stability period associated with the initial measurement period. So that is September 1 of 19 through 8/31 of 2020. If he didn't hit full-time hours, you wouldn't need to give him an offer there. Now, their SMP, their standard measurement period, starts June 1st of 19 and goes all the way to May 31st, of 2020. So Carter obviously is going to fall in there during part of his initial measurement period and part of his stability period associated with the initial measurement period. So you're going to measure him a second time. From then on, he will always fall into that same SMP every year after. So if he hits full-time hours, you need to back up his offer date on to July 1st of 2020. If he's not full-time, then you don't need an offer during that stability period of July 1st, 20 through June 30th, 2021. Remember, in the ACA, there's many places where I like to say the employee always wins, and this is one of them. So as soon as Carter hits full-time status, whether that be in the SMP, you need to give him the offer wherever it's best for him. So you don't get to wait until the initial measurement period, the stability period associated with the initial measurement period is done. You don't get to wait till September 1st of 2020. You have to back up that offer date to 7/1 of 2020 in this example. So now let's flip this around, and let's say Carter was actually hired as a full-time employee. What does that change? Well, what that change is Carter doesn't get an initial measurement period. Remember, that initial measurement period is not for full-time employees. So during that initial measurement period, Carter would actually be measured monthly. He's actually going to be measured monthly all the way up until 7/1 of 2020. And if he hits 130 hours per month, he would need an offer. Then on 7/1 of 2020, we're going to go back and look at that fully completed SMP to determine if he hits 1560 in that SMP. That's going to be the determining factor if he gets an offer on July 1st of 2020. So a little bit different rules there for full-time versus part-time employees. Now remember, hours of service, that includes everything like your vacation, your holiday, your jury duty. All of that, all those hours of service are considered when you're looking at that look back measurement period or the IMP. Now I put this in here because we have a lot of people that join these webinars that sit on a school board, and I think it's important that they have a little bit of knowledge on how those educational institutions work. So let's say I have a 9-month contract employee. You have to fill in those summer hours, those 3 months. I always call them phantom hours. So you have to average what their hours are during the 9 months and put those in the summer months. Otherwise, all those 9-month contract employees, when you use a 12-month look back measurement period, would likely be deemed not full-time. So we have some special unpaid leave here. I put this in here because remember, if you're using the look back measurement method, and someone goes on one of these special leaves, notice furlough is not a special leave. So your special leaves are your FMLA, they're your military duty or your jury duty. If you're gone on one of those and you use a 12-month look back, and let's say that I have an employee that's out on a 2-month FMLA leave, then that look back measurement period is only 10 months. So if they work 10 times 130, so 1,300 hours, they would be deemed a full-time employee for that next stability period. You can't harm someone for being on one of those special unpaid leaves. So normally when an employee is in their stability period, their status is locked, right? You had the benefit of using the look back measurement period. So now in the following stability period, that employee's status will be locked. There is a way you can unlock them, so to speak. So if you look in the rules, if I have an employee that reduces their hours, and let's say they take a part-time job working for you instead of their full-time job, and let's say they take that on April 15th, as long as they work 3 full consecutive months, averaging under 30 hours a week, then the first day of the 4th month, you can start measuring them monthly and classify them as a part-time employee, assuming that every month they hit under 130 hours. And you can do that until they complete the full next SMP. Now, in order to do this, that employee would have had to been offered insurance that met the minimum value standards back when they were first hired full-time. A lot of these employees are offered COBRA. You'll see that in our examples, but remember COBRA coverage, although it's considered an offer of coverage, which is good because it covers our 95% rule, it's oftentimes not affordable, so it could open you up for that 4980 HB penalty. Now remember, if someone takes COBRA, then you really don't care about that penalty, because if they take your insurance, they cannot and should not qualify for a premium tax credit. So if someone's on your COBRA and you get a 1411 certification from the exchange saying, hey, John Doe received a premium tax credit, then you write back and say, he's not eligible for a premium tax credit, he's on our COBRA coverage. So I like to put this slide in here. It's often overlooked. If you rehire employees, and it doesn't matter whether you use the monthly or the look back measurement method, if you rehire someone, don't rehire them until after 13 weeks. Because if you rehire them within 13 weeks, 26 weeks if you're a school district, it's as if they never really left. So let's say that I hire John Doe after 12 weeks of him being terminated, and I hire him on August 15th. He does not get to have a whole new waiting period. He needs an offer on the first of the following month. So September 1st, he needs an offer. Again, he does not get a new waiting period. Now, assume that John Doe came back and he had been a part-time employee based on the stability period that he was in when he left. Then we wouldn't need to give him an offer because he comes on as he left off. Now, when it comes to furloughs, if you're using the monthly measurement method, you can kind of tone out for just a minute here because it's not applicable. But if you're using the look back measurement method, those furloughed employees are still technically your employees. And if they're full-time and in their stability period, you need to keep that offer open to them. Now, if they're gone for more than 13 weeks and they come back, you could restart their waiting period, although I don't know any employers that are. But basically, you do have to offer that coverage to them during their furloughs. Now, remember, COBRA coverage is also considered an offer of coverage. It just doesn't meet that 4980 HB test typically because it's unaffordable in most cases. If you're using the monthly, remember furloughs really doesn't impact the monthly because you're not hitting 130 hours every month. Obviously, you're in furlough and you don't have any hours. So I put this reimbursement of individual premiums in here. It kind of piggybacks off that ICRA slide we had earlier. Just remember, there's a $100 per day per person penalty if you're reimbursing someone for individual premiums and you don't have an ICRA, a QSERA, or a one-person HRA plan set up. Those penalties can add up quite quickly. Obviously, if you're a for-profit, you would worry about the tax deductibility of those penalties. So here's our due dates. Again, we went through that at the beginning when we talked about what was new. These penalties, I believe they ratcheted up about $10 from last year, if I'm correct. As long as you're making a good faith effort and filing on time, you should be able to get out of these penalties. Again, respond to those notices timely. In 2021, these penalties are going to be, I guess, a little bit more scary, if you will, because you're not going to be able to get out of those penalties as easily because we won't have that good faith effort. So here are the max penalties directly from the IRS website. So now we're going to talk about the form. So we have the 1095B form and the 1095C form. Remember, those B forms are for those individuals who are small employers with self-funded plans. You are doing that because you have to give those employees a form saying, hey, Tanya and her husband and her kids had insurance for these months. Unless you're going to put that on the website for me to request that from you. If you're a large employer, you have the C forms to file. If you're fully insured, you're going to do parts 1 and part 2. If you're self-insured, you're going to do parts 1 through 3 on the 1095C. As we'll see in a minute, that 1095C has changed a bit. I should note that if you're part of a controlled group, you need to look at that control group to see if you're a large employer or not. So I can't own 5 businesses and each business have 40 employees and think each business would not be considered an ALE. So here's our 1094-C form. So I do have a slide coming up on some common errors that I see on the 1094-C, but I'm just going to leave this screen up and walk you through it. So when you're filing this form, make sure that you complete all the way down to line 7 and 8. I see some people not putting in line 7 or 8. Make sure you complete that. I'm assuming 9 through 16 isn't applicable to most of you, so I'm going to skip that. Lines 18 and line 20 should always be the same. How many forms are you filing with this? Now, if you're a really large entity and you have different divisions within the same EIN, there's a different rule if each division is filing their own forms. It could be, you could use this to have different number of forms submitted. I suspect that's none of you on this call, so all of you should have line 18 and line 20 be the same. If you're not going to check line 19, the IRS isn't going to think this is the final 1094 coming through. They're going to wait for the final one to come through, and you're going to get a notice if it's not filed. So line 19 says, is this an authoritative transmittal? You need to check that box. If you're not part of a controlled group, you'd check no on box 21. Now, if you have a 1A offer for that qualified offer, check box 22A for a qualified offer. If you have 98% of your employees that are full-time are offered coverage that's affordable, and if that offer is going to the spouse, and if the spouse and dependents, I should say, are offered insurance, actually it's not the spouse, it's just the dependents, my apologies, and you're offering it to 98%, then you can check box D. Now the benefits to checking box 22D are you don't have to fill out column B here on page 2. And remember what we said earlier, when you're submitting information to the IRS, less is more. If you don't have to give the IRS something, don't give it to them. It's just another chance that you could make an error. So again, if you fill out box 22D, leave column B blank. I see column A being blank often. If you leave this blank, the IRS defaults your answer to mean no, that you didn't offer insurance to 95% of your full-time employees. Another thing I see being done wrong here is people get super excited, so they check all 13 boxes. That's not right. You either check the all 12 months or each individual month. And then as far as the total employee count goes, there's 5 different ways you can do that count. It's right in the instructions. I'm not going to bore you with the details there, but there's a specific count that you need to use, and use that same method for all the months. If you're a large part of a controlled group, and that's why you're a large employer, you would check the months that you're part of that ALE group. And then remember, I don't have it on here, but on page 3 of your 1094-C, that is where you would put those related entities in descending order of the full-time employees. So here I wrote down what those misconceptions were. Now let's look at the 1095-C. So super exciting. For the first time, this form has changed. So if you notice here, it'll ask you what the employee's age is on January 1st. I suspect that's not applicable to most of you on this form. That, as well as line 17, is only applicable if you offer an ICRA. So if you do not offer an ICRA, then do not put the employee's age on January 1st here, or the zip code on line 17. However, new this month, you do have to put the 2-digit plan start month. I should have said new this year, sorry. So put in that 2-digit start month. So if you don't have a plan and you're filing these forms because you're an ALE, your start month is 00. So another thing I see done incorrectly on this form is when you're looking at line 14, you either need to use the all 12 months box or again, each individual month, but line 14, every single month has to have something in it or use the all 12 months box. If you're putting in your the employee cost of coverage, you have to use the 2 cents, right? So if it's $100, it's 100.00. Line 16, that's where I say use a safe harbor if you can. If you put in a code on line 14 saying, hey, I offered Tanya insurance, it was $100, and you chose not to use the qualified offer 1A method, and you don't put anything in line 16, that just means that maybe my W-2 was $5,000 a year, and that wasn't affordable to me to pay $100 per month for that coverage. So leaving that line 16 blank opens you up for a potential penalty. Again, if you're using a 1A code as well as a 1G code, then it's fine. Then you're not to put anything in line 15, and that 1A code, you don't have to put anything in line 16. Again, I would recommend not. If you put in a 1H saying, hey, I didn't have an offer, you say, well, Tanya, you weren't working for me. Then you need to put in a 1H and a 2A telling the IRS she didn't have an offer because she wasn't working for me. What I see a lot of employers doing is they'll say, well, Tanya started working for me in October. She had the offer in November. So we're just going to code November and December. That's not right. You have to complete the entire form, or next year you will receive a nice penalty from the IRS, likely to not be abated. So here's where I say, remember, put in the 2-digit plan year. That's required. So if you don't fill that out on your 1095-C forms this year, they are going to be wrong. So here we already went through this, so I'm going to skip this. We have some common coding here, same as last year, other than the qualified offer dollar amount threshold changes. So if you have a qualified offer and you have a fiscal plan year, again, let's use that July 1st plan year, and I'm using a qualified offer. That means for January through June, I can't, as an employee, pay more than $99.75 for self-only coverage. And then starting in July, that would be 101.79. So here's also some common coding. If you do not have a self-funded plan, you will not use a 1G code. So you only use a 1G if you're offering coverage for someone who was not a full-time employee or a non-employee, like a board of director. And you're simply giving them a form to report Part 3. If you noticed on that 1095-C, Part 3 isn't on that first page of the form. It's actually over on page 2 this year of the form. So again, that Part 3 pushed over into page 2. Make sure that if you have a self-funded plan, you are still reporting that information, and you're not just thinking it wasn't required because there's no individual mandate and because it's not on page 1 this year. So COBRA offerings, COBRA is hardly, if ever, done correctly for some reason. So if you're offering COBRA coverage due to a reduction in hours, it's coded as an offer of coverage, the COBRA amount, and a 2C if I take the coverage. If I don't take the coverage and I'm deemed part-time, then you can flip that over to a 2B. If you don't offer a 1E offer where it's to the employee, the spouse, and the dependents, then you can flip that over to only having a self-offer of COBRA coverage, and that's a 1B code. Now, if I offer COBRA coverage due to termination, whether or not I take that COBRA coverage, that COBRA offering defaults to a 1H2A, meaning there was no offer of coverage because I wasn't an employee. Now, typically COBRA coverage is deemed an offer of coverage, but because it's with a terminated employee, that's why you put a 1H2A. And that following year, it would be a 1G. Again, you're giving that form to the employee because you have a self-funded plan. Otherwise, you wouldn't use that 1G code. If you use a 1G code, it has to be used for all 12 months, and you don't put anything in lines 15 or 16. So we're going to go through a couple of these just so we can get through maybe 1 or 2 of those examples before our 2 o'clock hour hits. So these are just some common questions or errors that I see, if you will. So I'm going to pick out a couple of these. So when we review forms for employers for code violation errors, we're just simply doing a review of line 14 and line 16. Does 14 say something different than line 16? And if so, you shouldn't submit that to the IRS. And if you look at number 4, that's a perfect example. So you cannot have a 1E offer and a 2A safe harbor code for the same month, because that's telling the employer I was offered coverage for every day of the month as a full-time employee, but I didn't work for the employer any day of the month. Well, so those two are conflicting, right? I should either have a 1E and a 2B, meaning I was part-time, or a 2C, meaning I accepted coverage, or a 2F saying, hey, I waived coverage, but it was affordable under the W-2, safe harbor, what have you. Another thing I see is employers, when they start an employee partway through a month, they will want to code that employee as part-time for that month. And so they'll want to put in a 2B. I'm looking at line 5 now. Really, that is supposed to be a 2D code for your first month of hire. Now, there's 6 different ways that you can use a 2D, and it's your limited assessment period. It's right in the instructions. Nothing has changed. Basically, your first month of hire should be a 2D, or your waiting period should be a 2D. Now, if I had someone who was hired part-time and I'm using the look back measurement method, and within that IMP, they flip to a full-time status, they do need an offer of coverage. They need an offer of coverage the first day of their 4th month. So in that case, I could have a 2D because I'm in my initial measurement period partway through the year. And then when I flip over to a full-time status, I could be a 1A or a 1E offer. If I have an IMP and I don't have that offer of coverage after that IMP, and it turns out I worked 2,000 hours, so I'm deemed a full-time employee, I don't get to use that 2D safe harbor code for that IMP for those 12 months. I only get to use it the first month of hire. So if you're using the look back measurement period and you have someone in that IMP, if they don't have an offer and they should have had an offer based on their hours after the IMP, you don't get that safe harbor code of a 2D for that whole IMP because you didn't do what you were supposed to do with the IMP. You only get it for the first month. Again, if you do this next year, that form will be wrong and you're opening yourself up to those penalties for filing in an incorrect form. If someone takes coverage for the entire month, that is a 2C. So I like to think of these codes as a kind of like a game of chess, if you will. One will trump another one. And a 2C code trumps almost any other code out there. So if you have someone on COBRA coverage and it's COBRA continuation coverage and they take it, then it's a 2C even if they're part-time because that code trumps. So let's look at this page and see if we can see one of the more common ones here. If someone accepts coverage, we just talked about not using that 2B, use that 2D code. Another thing I see clients do is they'll have someone get divorced through the year and they have a self-funded plan and they want to give that divorced, the spouse of the divorced employee their own form. That's fine, and you should once they go on their own plan. But if they're on their spouse's plan and they don't go on their own plan, they don't get their own form. So you're not required to give it to them. The rules say you're not to give it to them. So if they stay on the employee's insurance, they are going to be on that employee's part 3 of the 1095C, and that employee is the one responsible for making a copy of that form and giving it to that spouse if she wants it. Remember, there's no individual mandate, so she really wouldn't need it. So now we're going to get into our examples here. So Lisa works part-time for a school for 10 years. She takes a long-term sub position on 1/20 of 20 and is offered insurance on 2/1 of 20. They use a look-back measurement period and they have a self-insured plan. What's her form look like? Well, if she takes coverage, it's a 1G because remember, she's in her stability period. So unless someone goes and switches to a full-time status in an IMP, if they switch to a full-time status and they're in their stability period, they're locked in as a part-time employee. You can still offer them insurance, but they're not deemed a full-time employee. So don't code them as a full-time employee because it's just one more person out there that you could potentially have open yourself up for an ESRP for. So again, she would be coded as a 1G if she takes the coverage, and then you're going to fill out part 3 for the months that she had coverage. Now, Jane works full-time for an employee for 10 years. She takes a part-time position, averaging less than 30 hours a week for the remainder of the calendar year. The insurance is $93. The employer drops her coverage on 1/31 of 20. She doesn't take COBRA continuation coverage as it's $800 a month. I probably wouldn't have taken it either. And it's deemed unaffordable. So what would her form look like? Well, January would be a 1A because it's a qualified offer, right? It's below $101.79. So we're going to code her as a 1A. However, in February, if we look down in February, she had worked for 10 years. The employer really shouldn't have dropped her offer until the first day of the fourth full month, right? Well, they did drop her offer. So she's still considered a full-time employee for February, March, and April. And so you're going to code her as a 1E $800.00, and you don't have a safe harbor code. You have no excuse for dropping her offer of coverage and making her offer unaffordable because she's still deemed a full-time employee. Now, assuming that she averaged under 30 hours a week, which it does say here she did, then we can start measuring her monthly on May 1st. And as long as she stays under 130 hours a month, she can be classified as a part-time employee. So we would code her as a 2B on line 16. So Cherise terminated employment on 4/30. Prior to termination, she was a full-time employee and enrolled in coverage. She enrolled in COBRA coverage at $800 a month. So January through April, she's going to be a 1A offer. She terminated employment though. So even though she enrolls in COBRA coverage, her form is going to show that she wasn't an employee May through December because she wasn't, and you don't want to code her as such and be open for an ESRP for her. So you're going to switch her down on May through December as a 1H2A. Now, if you have a self-funded plan, you're going to check that box in Part 3 for all 12 months because she would have had coverage for all 12 months. Now, if she stays on that COBRA plan for the following year, and you're self-funded, assuming the rules don't change, then next year her form is going to be a 1G. And again, you're going to mark the boxes down below on the months she had coverage. Now, in that next year, in 2021, let's say she only has coverage for one day in January of 2021, and then she flips over to her new employer's coverage. You'd still need to give her a form in 2021, code her as a 1G. And remember, Part 3, if you have coverage for one day of the month, it's a coverage for the entire month. You'd check that box down below. Different rules for Part 2 than Part 3. So Stella here takes a part-time position on March 1st of 2020, enrolls in COBRA coverage at that date for $800 a month. Obviously, we have a lot of COBRA examples here because we seem to see a lot of COBRA coding being done incorrectly. So prior to this, she was full-time and enrolled in coverage at $93 a month. So again, January through February, she's a 1A, but because she takes that COBRA coverage, you don't really care if it's affordable or not because 2C trumps that affordability code. So it also trumps the part-time code. So you're going to code her as 1E, $800, and a 2C. Here is that example where we have that divorced individual. So I think I talked through this. If you can read through that example, and we're going to skip ahead to Molly here. Molly is hired full-time on April 15th of 2020 and accepts coverage. She terminates on May 28th. She doesn't get a form because she never got out of her limited assessment period. In other words, her waiting period. Since she never had a month where she worked outside that waiting period, she doesn't need a form. Remember, less forms to the IRS is better. We one time had an employer say, well, I'm just going to give everybody a form because then I got all of my bases covered and I don't have to worry about that penalty for not giving a form out. Well, that's not a good idea either because every form you put out is a potential penalty coming back in. So you want to make sure there's a happy medium, obviously, of where those forms, how many forms you should put out. So with that, we're going to go through our last example, and then I'll see Amy if we have any questions. Jackson was hired as part-time on October 2nd. On April 15th, the following year, he accepted a full-time position and takes coverage effective May 1st. So in effect, he was hired as a part-time employee and he was in his IMP. But remember, if you take a full-time position within that IMP, you need an offer of coverage by the first day of the fourth month. So he's going to be coded a 1H2D during that IMP. And then when he gets that full-time position offer of coverage, you're going to flip him over to a 1E2C because he takes coverage. So when you're doing your forms, put all of this information, I'm sorry, I have a very fast mouse, put all of this information in your folder in case you get an IRS notice. All of it will be in the same place. Again, since there's no statute of limitations, easier to do it now than 7 years down the road. So with that, Amy, do we have any questions that came through on the chat?
Nope, nothing
Not that
there.
okay, I don't see anything either. All right, well, thank you everyone for joining us today. Again, my contact information is on that last slide. If you have any questions, please send me an email or give me a call. I hope you all have a good rest of your day and stay safe.